This chart shows the equity risk premium of the S&P 500 relative to the 10-year Treasury yield, which answers one core question: why own stocks instead of bonds? Mechanically, ERP is the earnings yield of equities minus the risk-free bond yield. When ERP is positive, investors are being compensated for taking equity risk. When it is near zero or negative, investors are accepting equity volatility for little or no extra return. Historically, high ERP appears during crises and fear-driven markets when future equity returns tend to be strong, while low ERP appears during periods of optimism and confidence, when stocks are priced richly relative to bonds. Today, ERP has compressed sharply to about minus 0.8% in February 2026. It is not deeply negative, but it is thin, meaning equities are no longer clearly superior to bonds on a yield basis. This doesn't imply an imminent crash, but we need to look a closer look at the current market relationships. This fair value framework pulls together earnings growth, payouts, the risk-free rate, interest rates, and the equity risk premium. What's especially compelling here is the baseline fair value anchor. The model assuming 7% long-term EPS growth and a 5% equity risk premium, which places the S&P 500 around 4,800. That level represents a balance point built on historical earnings growth and a reasonable risk premium. No heroic assumptions required. The base S&P 500 price index is trading well above that, a clear overvaluation. The pink line is the investment-grade option-adjusted spread. In plain English, it's the extra yield investors demand to lend to high-quality corporations instead of the U.S. government, after stripping out bond options. When this spread is low, credit is easy, and confidence is high, meaning the cost of capital is supportive of higher equity valuations. When it spikes, markets are pricing in risk and tightening conditions. Historically, this credit signal aligns closely with equity risk premia and fair value estimates. Margins measure how much profit a company keeps from each dollar of revenue. It answers, after paying workers, suppliers, rent, energy, and overhead, how much is left? Earnings are driven by two levers. First, revenue growth, selling more stuff or charging more. And second, margins, keeping more of each dollar. During the past few years, margins were the drivers of earnings. High margins raise earnings without needing higher growth, and also justify higher PE ratios. That's why models that include margins plus credit spreads explain so much of valuation history. This chart decomposes equity valuation by asking how much of the S&P 500's level can be explained by margins and credit spread. The black line is the actual S&P 500 price index. The purple line represents the model implied fair value, derived from a multivariable regression using investment-grade credit spreads and U.S. operating margins. This clearly shows the markets are nowhere near the crazy 2001 dot-com bubble, which shows up a significantly greater deviation in this chart. Credit spreads capture risk appetite and the cost of capital, while margins capture corporate profitability. When spreads are tight and margins are high, the model justifies higher equity valuations. When spreads widen or margins compress, fair value falls. The model explains roughly 76% of market variability, which is unusually high for equity valuation work. The current markets are expecting success, they expect companies to thrive, and markets are on pretty good track given this regression model comparison. We're really continuing this roughly 17-year-old secular bull market since 2009. And while many indicators like the cap ratio show an extreme overvaluation, it's always necessary to look deep underneath what's going on. It turns out the real bubble cracking might be in the silver or gold market. Especially silver has been an insane bubble. That bubble is now drastically popping. On January 28, 2026, silver traded at roughly $117 per ounce. By February 5th, the price had fallen to around $70, a decline of nearly 40% in just over a week. For context, 1 year earlier, on February 5th, 2025, silver traded near $30 per ounce. That implies the price nearly quadrupled in a single year before sharply reversing. Historically, silver has exhibited exactly this type of behavior. Unlike equities, precious metals lack cash flows, earnings, or dividends, making it impossible to anchor valuations to intrinsic fundamentals. This structural feature makes commodities, and silver in particular, far more prone to extreme overshoots and subsequent crashes than equity markets, where valuations are at least constrained by earnings and margins. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenaius.